Hello all. The next topic that we'll be discussing is deductions from chapter 6A. When you say chapter 6A, it's not your chapter number in your model. It's a chapter number in your Income Tax Act. So the chapter 6A specifically talks about deductions. And in your model, it is in chapter 3 of model 3. Now, what do you mean by deductions? So when you say deductions, first thing that we need to understand is there is something called exemption. There is something called deductions. How is it different? Very basic difference. Exemption is discussed in section 10. It is excluded from the total income. So it is not at all part of your total income. But your deductions is first included and then deducted. So which means it is a part of your gross total income. And both these exemption income or deductions could sometimes be 100% or sometimes be part of it. For example, HRA. HRA is an exemption discussed under section 10 clause 13A, where the exemption is partly. So it could be whole or partly. So basically there is a formula or there is a method in which you arrive at how much of house rent allowance is exempt. So similarly, deduction also, sometimes it is 100%, sometimes it's based on some calculation or limits that are in place. So this is what we need to understand broadly about exemption deductions. Now, knowing what deduction is, if you have to look at this chapter 6A, the section starts with 80A. So 80A is typically a charging section. When we said charging section, we said a section which gives the power to the Income Tax Act to charge tax on particular income. So this is called charging section. Section 15 for salary, 22 for house property, 28 for PGBP, 45 for capital gain, 56 for income from household. So these are all called charging section, which tells you that these income are taxable in your hand. So this is what charging section is. But when it comes to deduction, what do you mean by charging section? A particular section which tells you that deduction can be provided on income. So the power to give deduction on a particular income is also called charging section. So charging section not only refers to a section where you can give power to tax, even power to deduction has to come through charging section only. So what does 80A says? 80A lists out the various sections in this deductions. It starts from 80C to 80U. And they say you can claim these from gross total income. Now, at the end of the day, they say that these are deductions and these are not exemptions. So since it is part of your total income, since it's included in the total income, you cannot have deductions more than the total income. So the maximum deduction you can get is only your gross total income, cannot be more than that. So the deduction has to be less than or equal to your gross total income. And what are the restrictions in place? Typically, what happens in certain deductions, when you're talking about situations like AOP, there are possibility that the member is also claiming, the AOP is also claiming. So we have to keep in mind for AOP and BOI, the one who can claim the deduction is only this AOP and this only the member. Once the AOP or BOI is claimed, the member cannot claim. So the member will lose the right since AOP or BOI has already claimed the deductions. And there are some of the deductions which are called profit-linked deductions. They are basically covered in your final chapters. So basically, when you say profit-linked deductions, it's relating to your business. So when you say relating to your business, chapter 6 has various headings. There is various category of deductions. So this 80 and all is heading A. And then you have some deductions which are under heading C. And then the third set of deductions is called heading C, which are called profit-linked deductions. So what do you mean by profit-linked deduction? It's basically on a amount of quantum of profit and gains of a particular undertaking or a particular entity. Now, this profit of that undertaking will be eligible for certain deductions, 100%, 50%, 30%. So depending upon the quantum of your profit, the deduction varies. So these are called profit-linked deductions. And such deductions is also allowed under this. The transactions that are covered under such deductions should be at market value. So which means it cannot be manipulated. So to simply explain, there is entity A, there is entity B. B is a tax holder unit where they're saying that it's 100% tax deduction. So which means whatever profit B makes, there is no tax involved. No, when there's A is also of the same group, same parent entity or same group entity. Now, when there's a transaction between A and B, what do you think will be the objective? So the objective will be to keep more profits in B or more profits in A. Of course, what will be the answer? Very straightforward answer. The answer will be B, because B is a tax holiday, so I'll try to shift profits there. So just for with that intention, if I'm doing a sales at a higher value or at a purchase at a lower value with this A, automatically I'll have to be adjusted. So this is called that your transfer price has to be on market value in the data. So this is heading C, not much of importance for individuals as such. And then moving on, what you have to keep in mind is when you're calculating deductions. So there is a computation methodology given in ATAB. So basically, for computing deduction under heading C, the relevant income computed on the provisions of the act shall be alone deemed to be gross total income. So which means when your deduction cannot exceed gross total income. We said that, right? Deductions cannot exceed gross total income. Now, what happens is in situations where there is this profit linked deductions, you might have couple of business. So in that case, what they're saying is when it comes to profit linked deduction, the computation of total income for that particular business should be independent. It should not be combined with which means the deduction for that particular profits is restricted to that profit. You cannot include the other profits or something. So that's why they say it has to be treated as if it's an individual business. So it must be treated as if it's an individual business. And to claim these benefits, return filing is mandatory. So no benefit of deduction as a heading C will be provided unless you're filing it on time. But there are some exceptions to this. 80 JJAA, 80 QQB, 80 RRB. So these sections typically are eligible to be claimed even when you're filing late return. So there is no restriction. Otherwise, generally, returns must be filed on time to claim your other deductions with respect to heading C. Whatever is the profit link deduction is what we are talking about. And what do you mean by gross total income? Gross total has been defined as all the income computed under each head, including clubbing, minus current year losses and carry forward losses. So if you're adjusting both the losses, whatever is a balance is your gross total income. So losses has to be adjusted before providing your gross total income. So this is what is being prescribed under section 80P. So these are the deductions types. So basically deductions types are categorized as payment basis, income basis, certain deductions only for income from other sources and other category. So when you say payment basis, we will be discussing from section 80C to 80GGC. When you say income basis, generally we said it's profit linked deductions, specifically which will be covered for your portions will be 80JJAA, QQB and RRB. Now, what about income from other sources? There are two broad deductions, that is 80TT and 80TTB. Now, what are the other sections that we are talking about? The other one which is left out is 80U. We'll be discussing about. So these are the four broad categories: payment basis, income from other sources, and then anything else which is not covered. So these are the deductions type that we're going to talk about. We'll of course start with section 80C. Just give me a minute. Okay, so we'll start with, of course, the first section. We'll start with 80C. So 80C has various deductions. The first and foremost, the most important deduction or a common deduction that we're talking about will be LIC. So LIC is discussed under section 80C. LIC can be claimed as a deduction under 80C. But to understand what are all the policies that are eligible for deductions, we need to understand section 10, clause 10D. So section 10, clause 10D talks about policies that are exempt. So only premium payments to such policies are eligible for deduction under 80C. To understand this, first we need to understand for whom all I can take a policy, the coverage. Okay. So it's basically very simple. Individual, spouse, any child. Individual, spouse, and any child are what is covered as your what you call is coverage area. Now, what is the proportion of deduction that we are talking about? Any premium paid can be claimed as deductions. Now, in this premium payment, we need to keep in mind that the premium limit, there is a limit on the premium on the total policy value. So this limit has changed over a period. So for policies which were obtained before 1st April 2012, even today, so it is only the taken date, the first date. So if it is occurred before 1st April 2012, even today, the maximum limit is 20% of ACSA. What is ACA? ACSA, actual capital sum assured. So it is 20% of actual capital sum assured. So that is the maximum time. So your premium cannot be more than the cap. So whatever is your sum assured, my premium can be there up to 20%, not more than 20%. Now there is a separate limit for April 12 to March 13. Okay. So for this 1 year alone, this 20% dropped to 10%, and they started calling the term as minimum capital sum assured, MCSA or MSA, minimum sum assured. Now, what is the difference between actual and minimum sum assured? See, over a period, the policy types have changed. So earlier, when you take a policy, there used to be one sum assured. But currently, the sum assured is a varied sum assured. Like as the claim progress, as the insurance policy progress over a period of time, automatically your sum assured keeps increasing. So when you start with, it would have been 1 lakh. When you're very prompt in payment, when you're following for a very longer period, this 1 lakh might slowly go to 2 lakh, 2.5 lakh, whatever. So there will be an increase in sum assured over a period, which is based on your payment mechanism, based on your age, based on your claim, whatever it is. Now, this thing, what they say is, for calculation for this, what should be considered is the minimum sum assured. So minimum sum assured, it doesn't talk about anything else. So the premium paid should not be more than 10% of minimum sum assured. So in the first year, it is 1 lakh. In the 5th year, it is 2 lakhs. You should only take 10% of 1 lakh, not 10% of 2 lakhs. So that's the difference that we're talking about. And what about the current policies? When you say current policies, it is applicable from 1st April 2013. So it's basically they're differentiating. The 10% remains. Okay, this remains. Whatever is discussed here remains here. But there's another classification. If a person is covered under section 80U or 80DDB. Now, what is 80U? You are a differently able person. That is, when you say you, the taxpayer. The taxpayer is a differently able person. So that is the 80U. And 80DDB is, I have a dependent for whom I'm going to contribute for a very specific disease, very huge disease, where I need to make some contributions. So for such persons, if I'm taking any 80DDB, they are automatically, their limit will be increased from 10% to 15%. So this is the limit that we are talking about. That is 10% in case of general policies, 15% in case of policies for persons covered under section 80U or 80DDB. So for them, then automatically it is there. Now, what are the other things you have to keep in mind? When you say other things that you have to keep in mind, so the actual capital sum assured, we already explained that the actual capital sum assured will be taken into consideration based on the amount. It must ignore the value of premium agreed to be written on the bonus, or otherwise over and above the sum. So what should be taken is only the sum assured. Nothing above should be taken. Exactly the amount of sum assured should be taken. And of course, we spoke about the minimum sum assured. So why is this all about? Only policies which are covered under section 10 clause 10D are eligible for premium to be claimed under section 80C. So this is what we have to keep in mind. Now, there is another provision called 80DD. 80DD. So when you say 80DD, it's a specific policy for differently differently able person. So such person, for such insurance, there are certain situations where any receipt will be taxable. So section 10 clause 10D talks about receipt from insurance. So when is it taxable? When is it not taxable? Based on the premium quantum, 20%, 10%, 15%, 10%. Based on this, your total receipt might be taxed or might not be taxed. Now, automatically what they're saying is, if it is relating to 80DD3, so then that policy will not be exempt. Same way, if a policy is towards scheme and insurance policy, then that is also not covered. What is key man insurance policy? We already discussed in business. Insurance policy is taken for the key managerial person. And in case if your policy is terminated within 2 years, in case of single premium, and if it's periodical premium, it is within 2 years. If it's within 2 years, the policy is terminated. The entire deduction which was claimed will now be treated as income. And from Finance Act 2021, there is a new scheme that is announced where exemption under 1010D will not be available for ULIPs that are taken after 1st February 2021. So it is not about existing policies. It is about new policies that are taken on or after 1st February 2021. If premium payable exceeds 2.5 lakhs, if premium payable exceeds 2.5 lakhs for any previous year during the term of the ULIP, then automatically what happens is that entire premium will be taxed as thing. So your maximum premium allowed in a year is only 2.5 lakhs. We spoke about 10%, 20%, 15%, but the maximum premium amount eligible is only 2.5 lakhs in a year for all plans put together. So if it's more than one ULIP also, it is 10. So this is only for ULIP. What is ULIP? Unit linked insurance policy. So this insurance policy will be linked to some equity market or something, securities market. So this ULIP value is based on your securities market. So this ULIP kind of policies, if you're having a premium of more than 2.5 lakhs in a year, then automatically the entire aggregate amount will be taxable. However, exemption under section 1010D will be available on sum received on death of person, even if premium has received. So this is a specific exclusion. At the time of death, there is no relaxation. Straight away, it is exempt. So the taxability arises only on persons who are paying premium at the time of when they are actually alive and paying premium. So when you're talking about receipt of 1010D, we said any receipt on such policies is taxable. But if it is relating after death of a person, then it is automatically exempt.